Welcome to the Corporate Treasury 101 podcast. We've spent the last few episodes going over interest rates, inflation, monetary policy, how all of these things are linked together, and why interest rates are so high right now. Now we get to link all of this back to our favorite topic and what we're all about on this podcast. How do interest rates affect corporate treasury? And specifically, in the world that we live in today, with interest rates going up, with higher inflation, how does that affect different businesses living today? Is it the same effect for everyone, or do some businesses win more than others in a time of high interest rates and high inflation? As always, guys, please do follow us on Instagram at Corporate Treasury 101, and also leave us a review on your favorite podcasting app so that more people can learn about the podcast. But with that, on with the episode. Again, we've talked a lot about macroeconomics.
Yes.
We've gone into a lot of detail. You've explained to me very well about how interest rates impact inflation and why inflation is so high right now and why interest rates are going up, etc., etc. We started this entire series about inflation and interest rates because interest rates are deeply connected to corporate treasury.
Absolutely.
Like we said earlier, all the topics that we've talked up until now, we've mentioned interest rates a lot. We've talked about short-term funding, short-term investments, financial risk management with interest rates in our risk management episodes. It's a very important topic to corporate treasury in general.
Yes.
So with that in mind, we have all the tools to now understand the impact on corporate treasury. What is the impact of interest rates on corporate treasury overall?
You just mentioned all the areas that interest rates play an important role in. So which one would you like to tackle first, Sam?
So how about start with short-term funding?
Absolutely. So the bad news first. I'm fine with that. So the idea is not to cover here why companies might need short-term funding. But if our listeners need or want to learn more about it, episodes 22 to 24 are the ones you might want to listen. Now, obviously, a rise in interest rates will lead to a higher cost of debt, right? So what is the cost of debt exactly? It is the effective interest rate that a company has to pay on its debt. Since we talk only about debt and not equity here, we mostly look at loans and bonds. Now, fun fact, you can look at the cost of debt before taking taxes into account, but also after. The reason is interest expenses are tax deductible.
Very fun fact, Guillaume, I'm sure.
Thank you, Sam.
So what does that mean for a corporate treasurer?
Absolutely. So it means that now that interest rates are rising, when you are going to look at your short-term funding and financing options, you need to be much more cautious about how much that debt is going to cost you, right? Higher interest rates mean higher cost of money. We just talked about it. So you want to think twice before contracting a new loan or issuing a new bond, because paying too much interest is a slippery slope towards insolvency and therefore potentially bankruptcy. So also, since interest rates rising can also mean slow down the economy, from a lender perspective, it could also mean that it's more risky to fund your activity. So if I'm an investor and you ask me for a loan, well, it might be that I will be even more cautious before agreeing to lend you money. That's the first consequence of it.
So now we are thinking as a corporate, right? And a corporate treasurer in a corporation.
Exactly.
You are the entity which the government is trying to control. Right?
Exactly.
So
to slow down.
Exactly. So if interest rates are high, you have this choice about, okay, is this initiative that I want to fund really worth it, because now the cost of borrowing is so high.
Exactly.
Right?
That's
so it really makes you think about it finally.
Yeah. So you might want to indeed think twice before borrowing money, and you might want to maybe focus on areas of your business that requires less external cash, or simply focus on more profitable business line. This is typically the impact of those monetary policy. Businesses will think twice before borrowing money because the cost of debt is higher now.
No, very clear. What about short-term investments then? So that's funding. What about making short-term investments, which is intrinsically linked, right?
Absolutely. And this is where the good news arrives. So if you're a corporate treasurer looking at short-term investment, it means that you have an excess of cash or that you are not using this cash on the short mid-term. So that's good news. The business is doing well, or at least well enough to produce an excess of cash that you can afford investing, right? Now, here again, we won't go over the different aspects of short-term investment nor the instruments, but only the impact of interest rates rise on it. If our listeners want to know more about that topic, we highly recommend to listen to episode 26 to 28.
Indeed. And then I remember in that episode, we talked about government bonds, for example, being a very good short-term investment. We said, just to summarize, the main criteria that a corporate treasurer has in doing short-term investment is safety of the money.
Yes.
Right? How liquid it is.
Absolutely.
And
the last one is
so
the yield.
The yield, indeed.
Absolutely.
So those are your three criteria.
Yes.
If you have it in a government bond, for example, it's very safe.
Yeah.
It's very liquid because the secondary market is good for it.
Absolutely.
And you get a good yield if you have a good interest rate.
Yes.
So it kind of is good news for you.
Exactly. And remember, there is less money and cash available on the market, right? This is the whole reason we are getting there with higher interest rate, which means your money is more valuable. So now, something else to consider, interest rates are rising. This is good for your lead. But interest rates rise, the very reason of it, they are rising to serve a greater purpose, to slow down the economy, right? Which means it is potentially riskier to invest your money as well, because if you invest money into something, but the economy is slowing down, well, the return on investment that you were expecting from this investment might not be as high as you expected. So you may want to pay attention to that factor and select carefully the counterparty you are lending money to.
So overall, in an economy where interest rates are high, if you don't have cash, it's hard to borrow.
It is.
And if you do have cash, you could have very good opportunities potentially because
Indeed.
cash is in limited supply.
Exactly.
Right. All of this goes very well into the last thing we talked about, which was financial risk management.
Absolutely.
So what's the impact on financial risk management in Treasury from high interest rates?
Yeah. Here, we want to focus on interest rate risk management, right? Because we remember that financial risk management also takes into account the foreign exchange risk management. So even if currency exchange rates might be affected by all we just described, the direct impact on corporate treasury concerns interest rate risk management mostly. So you remember that we said the risk about interest rate is when you have loans or other debt instruments which you pay variable interest on. For those who want to reminder about LIBOR and the mechanism here, there is an episode fully about financial risk management and hedging, which is episode 15. But let's say you contracted a loan at LIBOR plus 2%. At the beginning of the loan, LIBOR was, let's say, 1%. So you were paying approximately 3% interest out of your loan. But now, LIBOR has just turned to 4% because interest rates are rising. And the total interest you are paying have more than doubled. This can seriously hurt your business, especially if you didn't hedge, which makes and emphasizes how important financial risk management is as a corporate treasurer, because not only you are responsible for this, but you need to foresee correctly what might happen in the coming months and or years and decide whether you need to hedge or not your interest rates based loans.
Okay, very clear. And so just to recap again exactly what LIBOR was in one word.
So LIBOR is how much money costs between two banks. If I'm a bank and I want to borrow money overnight, how much another bank, another financial institution will lend me that money for?
Yeah.
And this is LIBOR.
So it's the interest rate between banks in a way, which again, all of these interest rates come off the base interest rate, which is set by the government bond and this corporate bank.
Exactly.
Central bank, sorry.
Yes.
And then hedging is, of course, offsetting your risk of your investments or of your exposures, let's say, of which indeed interest rate risk was definitely one that we talked about.
Exactly.
So not only do you need to consider as a corporate treasurer on your long-term debt, right, from your short-term funding or etc., but also the day-to-day debt.
Yes.
Right. So we talked a lot about in the past episodes about if you have negative bank balances, maybe you're covering for those. You have interest rates on your negative bank balances. If you're not got a good cash pooling system set up, for example,
for instance,
and you have these overnight loans,
yeah,
you have overnight investments as well, which banks can set up. So maybe you're winning there as well.
Yeah.
So there's all these different scales of time which you need to be thinking about, and especially in a turbulent interest rate world where we had relative stability on interest rates over the last 5 years,
Yes.
it was almost
That's it.
always 0.5%. Now finally we're seeing interest rates go up. It really changes the corporate treasury landscape.
Precisely. Hence, the importance of hedging. And your ongoing investment is also affected from that point of view, right? Let's say 3 months ago you invested into an instrument that has a maturity of 12 months. So the investment you made, not the borrowing. For the coming 9 months, your investment is going to bring you less money than it could since interest rates are rising. And you'd better be off with a new one, up to date regarding the market and investment instruments. So it's really a two-way street here. Both funding and investment, and it's all has an umbrella over it, which is financial risk management, because how do you measure and act on those different changes in the economy?
Mm-hmm. Very interesting. So it's an interesting time to be a corporate treasurer.
It most certainly is. Business is booming.
What about banking relationships? I mean, these banks are going through all this turmoil. Your, let's say, commercial bank is in this relationship with the central bank, and then you as a corporate treasurer in this relationship with your commercial bank.
Absolutely.
How are banking relationships affected in these turbulent times?
So, among all the things we just explained, we saw that commercial and investment banks are at the center of this all, right? They are the intermediary between the central banks and the market and the corporate treasurer. The rise in interest rates mean that their whole strategy is impacted, and therefore the recommendations they make to their clients and their conditions are impacted as well. They will be much more keen to have a lot of your money into their accounts. They will not push for investment anymore because they are getting a lot of interest out of their account in the ECB. So they will incentivize you. Look, keep your money at my bank. You will get interest out of it. I will get interest out of it. Win-win. So,
and it's safe.
And it's relatively safe, yeah.
Which, as you mentioned earlier, wasn't the case in Europe, right? You said there was even negative interest rates with the European Central Bank at one point.
Exactly.
Now, those interest rates that the European Central Bank is providing to the commercial banks is positive and quite interesting overall.
Exactly.
It's a different landscape to what it was a year ago.
Precisely. And on the other hand, those banks will make you pay more money for lending you, right?
Yeah.
As we just described. And not only that, they will be more cautious about whom they are lending money to, because there will be less money on the market overall. So you need to keep, but that's a rule in general, but especially in those times, you need to keep a strong relationship with your bank, because either you need or have cash. Your bank is the driver of all this. I mean, you are the driver, but the bank will be the instrument of all this. So you need to keep a close relationship on how you manage all this money and which instrument your banks recommend you.
Okay. So to overall summarize then, in a period where we're going into now with high interest rates, as a corporate treasurer, your short-term funding is very expensive.
Yes.
Right?
Exactly.
Your short-term investing could be quite interesting.
Exactly.
Right? So if you have cash, great. It's a nice time to have a safe, good yield.
Yes.
But if you don't have cash, it's a really hard time to borrow.
Exactly.
And amongst all of this, you need to be very close to your bank, because you're going to be hedging a lot of the time, and they're going to help you hedge for sure. But also, they're the ones that are, driving with these interest rates and saying, hey, look, yeah, we have some good opportunities, or we don't, etc., etc. We trust you to give us the money back. So although it's expensive to lend you money, and we're going to charge you a lot to lend money from us, we know you can pay it back, so we're willing to take that risk. However, maybe with other ones that you don't have as good relationship, you won't have. Right?
That was quite a good recap.
And all of this comes again from inflation being intricately linked to interest rates.
Precisely.
And the government and the central bank trying to reduce the overall velocity of money in the economy, right? The speed at which money is moving around and how much is being spent by increasing interest rates. And all these are all the ways that a corporate treasurer would be affected by that.
Indeed.
Very cool. Thank you very much.
Thank you, Hussam.